but we're doing it now because I think it's the most interesting story in the market. It's Tesla. Right now, it hits another new low. The market cap has fallen now below Walmart and JP Morgan. That's stunning in and of itself. If you consider where it started this year, Joe, it was north of $1.2 trillion. Okay? Now, it is, as I look at it now, it is like $355 billion. That, to me, is emblematic of the story of the year in the stock market itself for stocks like that.
Without question. The beginning of the downfall for Tesla was in early April when Elon Musk announced the stake in Twitter. At that point, the stock was 10% higher on the year.
Not 10% higher than where it is now.
10% higher
in the green.
The year. In the green.
For the year.
Subsequent to that, in 4 separate stock sales, Elon Musk has sold $23 billion worth of stock. Now, he's tried to defend the stock. He has split the stock. He has dangled a stock buyback. He has said he will no longer be the CEO of Twitter. He's attempted everything he possibly can. What he cannot do is he cannot defend against the massive ownership that existed in this company. And unfortunately, for those that do own it, the cost of capital has changed so dynamically that ownership is being liquidated in what I think is one of the most dramatic equity liquidations I've witnessed since 2000.
So momentum is a powerful thing.
Powerful.
Up and down. Now, you own the stock.
We do.
Through the Joe T ETF.
Correct.
Now, if I'm a betting man, and sometimes I am a betting man, I'm thinking that when you rebalance, which is coming at the end of the year, and we're going to find out shortly after that what
end of January
current holdings are, that Tesla may not be in the Joe T. Can you give us an idea, if you're able to, on how you're thinking about this right now?
I'm going to give you my best Bill Belichick. I'm on overtime the last day of January.
You're on to Cincinnati, in other words. Correct. You're not talking about it now, and it's, I'm sure, because just from a regulatory standpoint, I would imagine that you're not able to get into any sort of key details about that. However, Jenny, how are we supposed to think about what's happening here as it sort of relates to the overall narrative in the stock market? Because I think they're tied together.
I think so. And actually, Scott, as I was driving in, I was listening to the radio, and you said something that was so smart that I texted it to myself so I'd re-quote it. You said, we are re-rating everything because of what lies ahead. And that, to me, that sentence encapsulates everything that's going on. That's Tesla, that's Peloton, which is what I think you were talking about. It's the reason energy is up, it's the reason utilities are up. Everything's being re-rated. It's not all in one direction. It's not all negative. Some of it's quite positive. But when we look at Twitter, when we look at Tesla, where I disagree with Joe a little bit is it wasn't Twitter that created the downfall. It was that the share price never should have been what it was. And that brings me back to that Charlie Munger quote, which I'm going to completely botch, which is something like any wonderful company can be turned into a terrible investment simply by driving up the share price too much. And that's what happened. That's what happened over the past several years. These share prices just got
You think Twitter had nothing to do?
Twitter was a catalyst that accelerated something that had to happen.
Okay, so if the stock was standing at the edge of the cliff,
something else
it was Twitter. No, it was Twitter that pushed it over.
No, because I
think you guys can both be right.
I think you're right.
I think you guys can both be right. I think Twitter was the most recent episode to puncture one of the tires, but the car was already in trouble because of where we are, what the Fed is doing, and as I said this morning, what lies ahead still.
I'm sorry, I disagree with both of you. The stock was 10% higher at the beginning of April. The market was already down. There was a degree of resiliency built into the stock.
There was, but only into the stock price. The thing is, it was trading back then at what, like 10 times the collective value of every single automotive company in the world.
Some people think it's a tech company.
Okay, but it just didn't make sense. At some point, the future cash flows need to justify the current valuation. And there was no version of Tesla at its peak that was ever justifiable, not for like 30 years of growth. And so that's what's happening. And that's what happened. It came down. It's just reconciling. The whole year is about reconciliation.
Yeah, I think that's a fine way to put it.
There's one more thing, Scott.
Go ahead, Michael, because if I'd have told you at the beginning of the year when Tesla was in the $1 trillion club with the Microsofts and the Apples, and I said that at the end of the year it was going to be in the Walmart club with a market cap that obviously is respectable. Any company would be respectable to have a $350 billion market cap. But if I'd have told you that it was going to go from $1.24 trillion to $355 billion, you told me I was crazy.
Not me. I would have said you're smart.